The last couple months in market neutral options trading have not been as easy as the first 9 months of this year, have they? October and November are proving to be trickier months. Our options trading desk for the first month of the year did not make money in October, for example. I'm guessing most of you watching this video had trouble in October also. That's because the market rallied and didn't look back. And so many of you would have struggled with your October trades. One of the most hard-hit strategies is the bearish butterfly. That had a lot of trouble in October and had a lot of trouble in November as well. So if you're a bearish butterfly trader, you were probably feeling the pain in October and your November trades as well. So you have two choices when you're in a position like that. One is you allow the trade to play out, you take your stop, your max loss, and you move on to the next month. Some people, however, would rather think of it this way, and it's a very legitimate way of trading, but if you adopt this way of trading, you need to think differently. You can be drawn down quite a bit on a trade, and we'll give you an example in a minute. If you're drawn down on the trade, but you don't want to hit your stop for whatever reasons, you can restructure a trade so that you can significantly improve the possibility of staying in the trade and reducing your loss, but you'll significantly reduce the probability you'll be able to win on the trade. Well, is that such a bad thing? If you're down 3% on a trade and you're able to work it down to 1%, that's the equivalent of starting a brand new trade and making 2% on it. In terms of your annual return, it's the same thing. So it's valid to say, I'm going to restructure my trade in a way where I have virtually no chance of winning, and it's not even my goal to win. My goal is to take this large drawdown and turn it into a small drawdown. So I want to show an example that actually came up this month. Here's a bearish butterfly trade. This is not the actual trade, but it's based on something that one of the traders on our desk did. He was drawn down, let's say hypothetically, in this case, 2,800 bucks on this bearish butterfly. Here is this hurtin' bearish butterfly. He was chasing the market all the way up in the Russell 2000 index, which had a really big rally in October, or in relation to the October trade, I should say. And so this particular trade was heavily drawn down, close to its max loss, which is $3,000. He's down 2,800 bucks, so he's very close to his max loss. Well, what he decided to do, I thought was interesting. He decided to restructure the trade and just trade a single butterfly. Now, a single butterfly has less theta in it, therefore less potential for profit, less potential or speed of appreciation. Here's the trade, and as you can see, it's pretty much of a long shot that you're going to make a profit on this trade. And the reason it's such a long shot is you've taken so many realized capital losses in implementing the strategy that you have just made the profit zone of the trade very, very small, given all of the losses you've taken on the trade so far. So trying to win this trade at this point is a long shot. And to try to do that is an unrealistic goal in most cases. It is not likely the market's just going to go through a subtle series of small moves and allow you to make money on this trade. Could it happen? Yes. Is it likely? Definitely not. So why shoot for something improbable as opposed to something more realistic, which is, how about if I try to take my $2,800 loss and knock some of that loss down? That way, I can improve my annual return on the bearish butterfly, even though I've given up on this month. Giving up doesn't mean accepting the loss level that you're at. Giving up means restructuring the trade so that you can reduce the loss and thereby improve your annual return. Now, you may ask, how do I decide how much of a loss reduction is appropriate? And my answer to that is set up the trade, the new structure of the trade, as though it were at a zero P&L. And then ask yourself, what would I realistically shoot for on this trade in the event of if I had started that trade today? So I've just arbitrarily said, if I put this trade on today and I was up $1,000 on the trade, I'd be happy. And you can see that that is not a ridiculous notion here. That would be a very reasonable time to take the trade off. Might even be a little early, but certainly to shoot for a $1,000 gain on this brand new trade would not be an unrealistic idea. And so, therefore, to shoot for a restructuring where you reduce your loss $1,000, in other words, reduce your loss from $2,800 down to $1,800, now that's a realistic goal. And on a bearish butterfly, which has a planned capital of $10,000 on a 2-lot, that's bringing your loss from 28% down to 18%. That's like a 10% win versus basically bagging the trade and taking a 28% or 30% loss. So it's actually a favorable concept to reduce the loss on a trade that's otherwise heavily drawn down. So that implies a $1,000 loss reduction. If you were to say, on a trade like this, I would expect to take it off at about a $1,000 gain. I'm just using a hypothetical number. You can plug in any number you want. The best way to do it is to say, if I started this trade today, given the way I trade, what would be the capital, what would be the profit I'd take the trade off? Now that is a realistic way of looking at this question. And so it turns out that today we're having a sell-off in the market today, and we actually would have reached, in this hypothetical example, the $1,000 loss reduction, or another way to put it is $1,000 on the new butterfly that was entered into mid-trade. And therefore, that would have been a successful reduction of your annual drawdown from negative 28% to minus 18%. This happened to be a great year for the bearish butterfly. So you're really subtracting 18% out of maybe over 100% return for the year. So your 100% return went to 82. That's still a pretty good return, I'm quite sure you would think. So, but it's better to drop it from 100 to 82 than from 100 to 72, which is where the trade was before this trader implemented his loss reduction approach to trading. So don't go for long shots. It's better to come up with a realistic restructuring of the trade to reduce the loss than to expose yourselves to a very unlikely recovery from a substantial drawdown. You're much better off from an annual return standpoint, reducing your losses in a month to a more realistic number, thereby improving your annual returns. If you follow this mindset of, I don't have to win every month, I just have to leave my losses, I've got to get my losses under control and leave losing months essentially intact, then you're going to live to trade another day, and long term you can be a successful trader.